Musqueam, and Tsleil-Waututh nations. And we are delighted to welcome you to the address from the Bank of Canada's Governor, Tiff Macklem. Today, he will speak about the importance of trade for ensuring that Canada's economic recovery will be sustainable. Governor Macklem will also discuss strategies for overcoming obstacles to growth. Following Governor Macklem's remarks, we will have a fireside chat, and I encourage you to take part in the discussion. We are using Slido, so you could submit questions. Just go to slido.com, and the password for today is Bank of Canada. Before we get underway, it takes a lot of support to put together an event like this one. We would like to acknowledge our community sponsor, Boyden, our preferred media partner, Business in Vancouver. And this event is presented in partnership with World Trade Center, Vancouver. We also want to thank our long-standing sponsors called our Pillar Partners. They include TELUS, CN, YVR, BCIT, and Air Canada. We are very grateful for the support of these 5 organizations whose annual partnerships and commitments enable the work of the Board of Trade. I now have the pleasure of introducing Tiff Macklem, Governor of the Bank of Canada. Mr. Macklem first joined the Bank of Canada in 1984 and held various senior positions, including Chief of Research and Advisor to the Governor. He was appointed as Deputy Governor in 2004 and Senior Deputy Governor in 2010. During the global financial crisis, Mr. Macklem was Associate Deputy Minister at the Department of Finance and represented Canada at the G7, G20, and Financial Stability Board. Now, before I turn the mic over, a reminder to please log on to slido.com and submit or vote for questions. And again, the event passcode for today is Bank of Canada. Over to you, Governor Macklem, and very nice to see you virtually.
Well, thank you, Bridget. Thank you for that introduction, and thank you for setting the stage. And thanks to so many of you for joining me virtually. For most of us, I expect the end of 2020 is not coming a moment too soon. The pandemic has affected everyone, and for too many, the hardship has been severe. Some of you have lost loved ones, some have lost their jobs or their businesses, and we all miss our family and friends, especially this time of year. For months, we've wondered when we can get back to more normal activities, and I wish I could be in Vancouver speaking to you in person and hearing your concerns directly. Unfortunately, the time for face-to-face meetings hasn't come yet. But we can be together virtually, and I thank you for the invitation to speak with you today. The recent positive news on vaccines provides some reassurance that more normal activities can resume sometime next year. However, the path from here to there looks difficult. A second wave of COVID is sweeping across much of the country, leading to renewed restrictions. These will weigh on economic growth early next year and increase the strain on Canadians and Canadian businesses. I don't want to downplay these difficulties. But today, I want to look past this second wave and focus on a critical piece of our economic recovery, trade. So far, household spending has led the way. But for the economy to fully recover, it needs to be firing on more than one cylinder. To be sustainable, the recovery must broaden to include exports and with it, business investment. Nous avons tous besoin de garder le moral à l'approche des fêtes. Alors, je souhaite terminer l'année avec un message d'optimisme prudent. Les exportations et les investissements des entreprises peuvent rebondir plus vite en sortant de cette récession qu'ils ne l'ont fait après la crise financière mondiale. Mais pour cela, il faudra tous nous relever les manches. Because we all need to lift our spirits as we head into the holiday season, I want to end this year with some cautious optimism. My message is that exports and business investment could bounce back from this recession more quickly than they did after the global financial crisis. But for this to happen, we all have some work to do. Allow me to start by looking back a decade to the recovery from the global financial crisis to compare how trade was evolving then with how it's evolving now. I'll show you what's at stake with a robust export recovery, and I'll close with some thoughts on how we can improve the odds of bringing this about. The global financial crisis pummeled the world economy back in 2008 and 2009. But Canada fared relatively well because of our strong financial system. Our recession was shorter and shallower than in most other economies, but our exports were hit hard, indeed harder than most. That's because of our close ties with the United States, which was the epicenter of the crisis. While global exports fell by less than 20%, Canadian exports fell by close to 30%. As is usual, demand for goods was particularly affected. As you can see in this chart, Canada swung from having a large trade surplus in goods to a small deficit. The red bars represent the trade balance in goods. And when this went negative, it pulled Canada's trade balance into deficit. Canadian exports began to recover immediately after the crisis, but the rebound stalled. Weak foreign demand, particularly in the US, was holding exports back. But that wasn't the whole story. Bank of Canada researchers spent a lot of time dissecting these disappointing exports, and they zeroed in on two fundamental issues: geography and competitiveness. 2/3 of Canada's underperformance was blamed on geography, who we trade with. Canadian export markets were concentrated in mature economies with relatively low growth, such as the United States, rather than faster-growing emerging market economies, largely in Asia. The remainder of this poor performance was tied to a lack of competitiveness. Unit labor costs in Canada were higher than elsewhere because of slow productivity growth and the impact of a stronger currency. Canada's regulatory regime and investment climate were also cited as impediments. Now let's look at how this past experience compares with today. While the period leading up to the global financial crisis was positive for trade, the period before the pandemic was anything but. Trade disputes arose between the US and several other economies, including Canada, the European Union, and particularly China. These disputes led to escalating tariffs and pervasive uncertainty about global policy. Bank researchers estimated that these factors combined would reduce global output by more than 1%. That's more than $1 trillion by the end of 2021. In this environment, it's no wonder Canadian companies were reluctant to invest and expand their export capacity. Another difference between these crises is that this time, trade and services has been affected much more than trade and goods. Take a look at this chart. The dashed line shows what took place after the global financial crisis. Exports of Canadian services, shown in blue, were barely affected, while exports of goods, shown in red, fell and took a long time to recover. By contrast, the solid lines show the experience with the pandemic. This time, both goods and services fell sharply. But this time, goods exports have rebounded, while services remain weak. Consider international tourism exports, which are vital to BC. Tourism has basically come to a full stop. Canadian education exports have also been hit hard by the pandemic. When a foreign student comes to Canada to study, the tuition counts as an export of educational services. The disproportionate impact of the pandemic on services has significant implications for Canada. Services exports are only about a quarter the size of goods exports, but services exports have been growing much more quickly than goods exports before the pandemic. You can see that in this chart. The green line shows the steady growth of services exports since 2015 to the start of the year, while the blue line shows only slow growth in goods. Then, of course, the pandemic turned everything upside down. While many services exporters will struggle until a vaccine is widely available, some goods exporters have been able to adapt to safety protocols and bounce back quickly. Motor vehicle and parts, for example, came to an almost complete stop in the spring. Since then, the sector has regained nearly all of the lost ground as factories adapted their value chains and production processes. The rapid rebound of goods exports is certainly encouraging. By October, the value of goods exports had recovered almost 90% of the loss seen in the spring. The point is, if struggling services sectors can hang on until a vaccine is widely available, Canada's export performance could avoid the serial disappointment of the period that followed the financial crisis. And this would help cement a sustainable recovery. Of course, this is by no means guaranteed. The rebound in goods exports could fizzle as companies complete their restocking. And the prolonged hardship could push some service exporters out of business. And the underlying competitiveness challenges that have restrained export growth over the past decade have not gone away. More recently, the Canadian dollar has been appreciating, largely reflecting a broad-based depreciation of the US dollar. This is hurting the competitiveness of our exporters in our largest market. Now, where does the trade story go from here? Let's imagine a couple of plausible scenarios. One pessimistic, one optimistic. In the pessimistic scenario, the global spread of COVID-19 fuels anti-globalization sentiment and a continued rise of protectionism. This is not far-fetched. A recent Ipsos poll found significant support among Canadians for measures that would make the country less reliant on international trade. And the same poll found much less support for measures that would help Canadian companies export more. This is troubling because international markets are essential for Canadian companies to achieve competitive scale. In the pessimistic scenario, we also fail to diversify our trade or improve our competitiveness. Rivalry and distrust between US and China thwart our efforts to develop export markets in Asia. Investment remains weak, and our productivity continues to lag. What's more, new market access for our energy products doesn't come on stream, holding back Canada's ability to ship our #1 export, oil. And without that market access, investment in cleaner oil extraction technologies dries up. The bottom line is that exports fail to rebound and trade does not become a reliable engine of growth. But in the optimistic scenario, many of these same forces break the other way. The strong rebound in world trade we have seen to date continues, and the protectionist forces that have dominated in recent years begin to fade. Unprecedented international cooperation to develop new vaccines and supply them across borders proves to be a potent demonstration of the benefits of globalization. That success shifts public opinion. Governments start to knock down the tariff walls that they had begun to build, and uncertainty lifts as governments recommit to a rule-based trading system. In the optimistic scenario, efforts to diversify markets for Canadian exports start to bear fruit. Canadian productivity improves as a result of increased investment and the deployment of new technologies, which boosts the economy's competitiveness. Canada and the new US administration cooperate on a North American approach to energy and climate change. Canada's oil and gas sector benefits from access to markets, and we start to see an integrated continental approach to business opportunities from low-carbon growth. In this scenario, we see a resurgence of trade and business investment, which bolsters our economic recovery. The stakes are high. Using one of the bank's economic projection models, bank economists estimated the impact of two scenarios that are much less extreme than the ones I've just described. You can see the results in this chart. In the staff optimistic scenario, Canada's trade balance would be more than $30 billion better by the end of 2024. This would roughly eliminate our current trade deficit. In the pessimistic scenario, exports would actually drift lower during the recovery and incomes would fall, and our current trade deficit would worsen by almost 60%. In reality, the outcome will probably fall somewhere between these two extremes. And obviously, we all hope that life turns out to be closer to the optimistic case than the pessimistic one. But hope is not a strategy. We need to think strategically to increase the odds of a strong trade recovery. I'm going to talk about 3 ways we can approach the issue: by looking at markets, products, and how Canada can win in the global marketplace. Business leaders and policymakers each have important roles to play. First, they need to work together to leverage, broaden, and deepen global markets for Canadian exports. Thanks to signing of the new NAFTA, CETA with the European Union, and the Trans-Pacific Partnership, Canada already has some of the best market access in the world. Further, we have numerous bilateral trade deals in place. The business community and governments across Canada need to come together, work together to leverage these market opportunities. The business community can capitalize on this market access by investing in people and in productive capacity. We know Canada has an incredibly diverse workforce. People have come from around the world to live here, bringing their global connections and knowledge with them. And we've seen clear evidence that shifting populations can drive trade. Smart companies can leverage Canada's workforce advantage to build global markets for their products. Companies can also look to global supply chains for growth opportunities. Supply chains are trending towards more regional networks around major global trade hubs. Global companies are investing in the resilience of their supply chains, and Canadian companies need to be ready to be part of the solution. As policymakers and business leaders, we have a responsibility to explain the importance of rules-based trade. We need to push for a renewal of the spirit of internationalism that served so many countries so well for decades. And we need to make sure the benefits of open trade are shared fairly within and across countries. With COVID-19 accelerating the digital economy, rules for digital trade and competition are more critical than ever. This also highlights the urgent need for a concerted international effort to improve the measurement of the digital economy. Now, as much as geographic diversification remains important, it's not going to be easy or happen quickly. So let's look at the issue from another angle. We do need to develop new, fast-growing markets for our products. But we also need to develop new, fast-growing products for our markets. We have to grow and scale up production of high-value goods and services that we can export. The BC economy offers some leading examples of how this approach could work. On the services side, there's lots of success stories in Vancouver, where the world's first commercial quantum computer was built, and now home of one of Canada's most important technology hubs. Activity in these hubs is driving strong growth in exports that are as easy to ship to South Africa as they are to Seattle. Canadian exports of knowledge-intensive services such as research and development, computer and information services, and intellectual property grew by close to 12% over the past 3 years. As you can see in this chart, these kinds of services shown in red are both growing rapidly and contributing to Canada's trade balance. It's clear that digital services, including e-commerce, online education, and application development, will be an important part of the future of trade. So will BC specialties such as video game production and animation studios. The pandemic is also accelerating growth in other technology services. Doctors and hospitals are finding new ways to use technology to provide healthcare virtually. With the explosion of remote office work, there are tremendous opportunities in the areas such as cybersecurity, cloud computing, and the development of virtual workplaces. Given the worldwide nature of the pandemic, advances in the digital economy can more easily become scalable, fast-growing exports. We've also seen a lot of BC companies innovating and applying new technology in traditional goods sectors. Think forestry. We know the industry is under pressure from long-term supply constraints, but companies are adapting. Instead of wasting bark, wood chips, and sawdust, companies are turning these into bioenergy. Canada is now the world's second-largest exporter of wood pellets, an attractive fuel replacement for coal in power plants. The mass timber industry provides another example. The 18-story Brock Commons tallwood house on the campus of UBC, which uses structural wood to replace most of the steel and cement, is a shining example of how Canadian innovation and know-how create high-value and sustainable products from our natural resources. You can find similar examples across other sectors, such as mining and agriculture. Finally, I want to mention another opportunity that is another strength of BC, renewable energy and other green technologies. This includes clean energy production, goods such as solar panels, and services such as design and construction. Vancouver is home to 1/4 of Canada's clean technology companies, with revenues of about $3.5 billion last year. The export potential of green technology is obvious, given global concerns about climate change. That brings me to my final topic, which is Canada's ability to compete and win in global markets. We won't be able to fully capitalize on our opportunities unless we take steps to improve our productivity and competitiveness. Businesses have the leading role to play here. Investment in productivity-enhancing machinery and equipment is vital. So is a commitment to research and development and to constantly train and reskill employees. Several factors contribute to business investment decisions. But right now, the Bank of Canada has given forward guidance that borrowing costs are going to be low for a long while. And there's light at the end of the tunnel as vaccines roll out. This seems like an opportune time for companies to look at how they judge the rate of return on potential investments, the so-called hurdle rate. Taking a longer-term approach to capital investment could unlock a myriad of viable growth opportunities. Policymakers, for their part, can help by removing barriers to business investment and impediments to growth of smaller firms. Let me mention 3 areas. First is the ongoing need to remove obstacles to interprovincial trade. This comes up regularly in the bank's conversations with business leaders. Over the past 9 months, the provinces and the federal government have demonstrated tremendous cooperation in dealing with the pandemic. Think what we could achieve if that same spirit of cooperation was applied to removing barriers to the movement of goods and services and professionals across provincial boundaries. A second area of focus is infrastructure. Exporters will remain reluctant to invest if the infrastructure to get their products to market doesn't exist. Canada has made some good progress here. The LNG plant being built at Kitimat is one notable example that will help our energy exports in the future. But more needs to be done. I met with leaders of a number of logistics companies last month. They shared their concerns about bottlenecks, particularly in ports. Fast-growing exports need reliable transportation infrastructure, including efficient, high-capacity ports. And I know that both the Port of Vancouver and the Port of Prince Rupert are working on major capacity expansions. This is encouraging. Boosting our export capacity also requires building the information and data infrastructure needed to compete in a digital world. A third area of focus is people. Our biggest asset is a well-educated and diverse workforce. For the past 4 years, the policies and attitudes of the U.S. administration have helped make Canada look more attractive to students and workers, and this has given us an advantage. With the incoming U.S. administration, Canadian schools and companies may have to fight harder to attract and retain talent. But being a welcoming country remains an important advantage, and immigration creates economic capacity. We need to focus on ensuring that Canada maintains a well-educated, multinational workforce to attract foreign investment, leading to increased exports. It's time for me to conclude. Le redressement de l'économie est à un stade crucial. La hausse à la court terme du nombre de cas de COVID pèse sur la croissance. Et le trou dans lequel se trouve notre économie pourrait même se creuser davantage. L'incertitude est grande et la reprise sera à la fois longue et en dents de scie. Il y a quand même lieu d'être prudemment optimiste que le commerce international se remette plus rapidement de la pandémie que de la crise financière mondiale, dont les entreprises canadiennes doivent se tenir prêtes. The economic recovery from the pandemic is at a very difficult stage. Near term, rising COVID infections will dampen growth and could even deepen our economic hole. Uncertainty is elevated, and the recovery is going to be long and choppy. Nevertheless, there is room for cautious optimism that international trade will recover more quickly from the pandemic than it did from the financial crisis, and Canadian businesses need to be ready. Since the initial shutdowns last spring, trade has bounced back faster than many economists had predicted. Recent international surveys suggest executives expect trade to be strong in 2021. And the news of effective new vaccines puts a more certain timeline on the resurgence in global demand. There is no single path to stronger exports, and as business leaders, you need to decide on the best strategies to move your company forward. These include investing in new markets and products and improving our competitiveness position. As a country, we need to leverage the broad trade access we have and work with like-minded countries to foster a renewed spirit of open, rules-based trade that works for the 21st century. We also need to remove barriers to investment and other obstacles that keep Canada punching below its weight in global markets. Think about the opportunities and imagine the possibilities. Canada has dynamic business leaders with good ideas, and Canadian businesses have responded to the pandemic with ingenuity. We also have a diverse, well-educated workforce and significant global market access. The Bank of Canada has pledged to support the investment climate by keeping borrowing costs low until economic slack is gone. Together, we can secure a resurgence in exports, broaden the recovery, and put the economy on a sound, sustainable path. Thank you very much.
Thank you very much, Governor Macklem. There's was a lot there for us to dig into, and I do have a number of questions coming from those who are watching at home or at their office, but I'll start with a couple of questions, and I want to start with maybe the tail end of your remarks where we were talking about the pandemic. Clearly, there is light at the end of the tunnel with the vaccine rollout, and you talked about being cautiously optimistic. So when you look at that first quarter of 2021, what concerns you most now that we're in this next phase of this pandemic?
Broadly speaking, the economic recovery is rolling out as we expected. We expected a really strong rebound in the third quarter. That materialized, and we've actually even seen a little more momentum going into the fourth quarter than we expected. So we're coming into the end of the year with a little more momentum. Having said that, it's very clear the COVID infections are spreading at a rising rate. Provinces, within different parts of provinces are having to put new and more stringent restrictions. And that will certainly weigh on growth in the first quarter. It'll certainly reduce growth, and the economy could even slide backwards. We said from the beginning that this would be a long recovery. It would be choppy and it would be uneven. And that, I'm afraid, is what we're seeing. And this rising case of COVID infections, this second wave is certainly going to put a chop in that recovery. I would underline, though, the arrival of new effective vaccines is a tremendously positive development, and it really puts a timeline, gives us more certainty about when we can start to get back to more normal activities, and it really reinforces we are going to get out of this.
Well, there's many of us on this call that have the same idea in mind, looking forward to a much brighter 2021. I want to move on and ask some other questions. I'm so glad that you mentioned competitiveness. Certainly your predecessor did, and it is something that is near and dear to the heart of the Greater Vancouver Board of Trade, and even speaking about interprovincial trade barriers. So you have a business community audience here, and you did speak in some detail about what the business community could do. Given they're in the thrust of the pandemic, and many of our businesses that will be listening come from either the tourism sector or the retail sector or some of the other disproportionately impacted industries, what more could the business community do as they are coming out of this pandemic to ensure that we remain a competitive region?
There was quite a few ideas in my prepared remarks, but maybe I'll just underline a few. Some parts of the service sector are really being crushed by the pandemic, and it's going to really be important that they can do whatever they can to hang on because the vaccines are coming, the recovery is coming, the resurgence in global demand is coming, and we really want to make sure we're there ready to seize those opportunities. Other parts of the service sector, services exports, are actually doing quite well. Technology is booming, for example. Supply chains globally are reconfiguring. Companies are diversifying their supply chains. They're building them around more regional hubs. And it's going to be really important for Canadian businesses to try to embed themselves and be in those supply chains and be part of those solutions. So, there's a couple of very immediate ideas coming out of the pandemic.
Great. You also did mention climate change, and that's something I want to ask a couple of questions about. We do have the new federal government climate change plan. Lots of people would say in British Columbia that we have a low carbon advantage. So can you speak a little bit more about the Bank of Canada, how you view climate change and what changes we can expect when it comes to our financial system?
I made some remarks a couple of weeks ago at the Public Policy Forum with respect to the bank's role in climate change. So let me just quickly summarize those. I'd highlight two elements. First of all, climate change is going to be a defining economic challenge. It's already started, and it's going to play out over the next few decades. It is critically important that the Bank of Canada has a very good understanding about how climate change is affecting and is going to affect the Canadian economy. That's very important for us in terms of the conduct of monetary policy. Secondly, the Bank of Canada has a mandate to promote the stability and the efficiency of the financial system. And here, certainly our work is focused mostly on risk, although the two are related. Climate risks are often underpriced, underappreciated in the market. And if we want to get capital allocated to its most productive value, if we want to minimize the risks of a disruptive adjustment, it's critical that those risks are properly identified, assessed, priced, and managed. The Bank of Canada is doing a few things to help the financial system do that. About a year ago, we started highlighting climate risks in our financial system review. And the idea is that by analyzing them, putting that analysis out, talking about it, people become more alive to those risks and they manage them better. Another thing we're doing, which we just announced several weeks ago, is together with OSFI and six Canadian financial institutions, we are running a pilot project to develop climate change scenarios that financial institutions can then use as part of their risk assessment. There's a lot of uncertainty about how climate change is going to play out, but uncertainty can't be an excuse for inaction. And scenarios are a key tool to help identify what could happen and get ready for different scenarios. The reason we're doing it is these scenarios are a lot of work. They require a lot of analysis, a lot of assumptions. And so the idea is that the Bank of Canada, together with OSFI, will develop these scenarios and work with a number of financial institutions as part of a pilot to develop the methodologies. That's going to make it easier for the financial system. It's also going to make the analysis more comparable across financial institutions.
Governor, can you say whether the Bank of Canada is contemplating policies then that might seek to use the levers of its credit lines and to corporate bond purchases then to limit credit given to specific sectors like fossil fuels, for example?
Well, I think there you're referring largely to our corporate bond purchase program. I guess what I would underline there is that this is an emergency measure. This was brought in when markets were seriously dysfunctional in March and April. And it's an emergency measure. It was there together with a whole series of other facilities to really restart credit markets. Credit markets, the functioning of credit markets is core to, they're the lifeblood of a market-based economic system. And a crucial role of central banks is to make sure they function, and you saw central banks around the world come in. That program is benchmarked against a reference portfolio that is reflective of the structure of the Canadian economy. So it does include energy companies, and some of those, of course, are fossil fuel producers. And I don't think in an emergency it's wise or fair or advisable to penalize certain sectors of the economy. We've got to support the economy that we have. These are relatively short-term emergency measures. Markets have now restarted, and although the corporate bond program is still open, it's being very little used because markets are reopened, and it's there really as a backstop. I just talked at some length about the things we are doing at climate change, but I think in a moment of crisis, you've got to support your whole economy.
Thank you. I want to go to some of the Slido questions now, and I'm just going to look off camera a little bit because I can see them here beside me. So I'm going to go down to the second question because the first question you've had an opportunity to address, Governor. So what are your thoughts on modern monetary theory, and how do you see it's impacting Canada?
Well, I'm going to be blunt here. I actually don't think much of modern monetary theory. I guess to be very blunt, direct, modern monetary theory seems to be more a collection of assertions than a theory. I can understand why, the fact that central banks around the world are buying government bonds as part of quantitative easing programs, I can understand how that's giving it a bit of a veneer of legitimacy. But the objectives of quantitative easing and the mechanics of quantitative easing are entirely different from modern monetary theory. Quantitative easing is a tool in our extended monetary policy toolkit that provides an alternative way of lowering interest rates than lowering our policy rate. Our policy rate's at the effective lower bound. By buying bonds further at the yield curve, we can lower the interest rates on government finance, which lowers the interest rates for everybody in the economy. And we're doing that to stimulate growth, support the recovery, and get inflation back to target. And as inflation gets back to target, we've been very clear, there is an exit strategy. We've indicated we will undertake quantitative easing until the recovery is well underway. Yes, it will cause inflation. That's what we need. Inflation's too low. We need to support the recovery and get inflation back to target. But once that's happened and we don't need that support anymore, we turn it off. Modern monetary theory, the idea there is that the monetary policy would simply finance the government indefinitely. There's, what empirical evidence there is on that has shown that that ends badly.
Thank you for that. Now, maybe on the same, in the same kind of line of questions then. So when we're talking about interest rates and you emphasizing that you're deeply skeptical around negative interest rates, can you talk about what you need to see to look rates dropping even further, perhaps even into negative territory? Can you comment on that at all?
Well, let me put it in a little bit of a broader context. We've indicated for some time that if we need to do more, we have a range of tools. That would include scaling up our quantitative easing program. We could, as we did last time, shift purchases further out the yield curve, which would have the effect of increasing the stimulative impact, further increasing the stimulative impact. We could use yield curve control. Some other central banks are targeting certain parts of the yield curve. That's an option. And getting to the couple of options you highlighted, there is also the possibility of lowering the effective lower bound from its current rate of 25 basis points to something that is still positive. Some central banks have even gone into negative territory. As we've indicated a number of times, the bar to go into negative territory would be particularly high. At least in the Canadian context, it looks more disruptive than helpful. It is in the toolkit. So we could use it, but we've certainly indicated on a number of occasions that the bar to do it would be quite high.
Thank you. Going to go back to Slido now, and the question at the top, talking more in broader terms about the recovery of the U.S. economy and the impact on the Canadian economy. What kind of comments can you offer there? Obviously, the economy recovery is different on both sides of the border, but what is the impact from one to the other?
Well, look, the U.S. is our largest export market by a long shot. It's a very important market for Canadian products, and the stronger the U.S. economy is, the more that will boost the Canadian economy. So certainly when we look at our own economic projections, one of the first things we do is assess the outlook for the U.S. economy. The U.S. economy has rebounded very well, and it has proved really quite resilient to COVID. It also has a second wave, in fact, much worse than Canada's, but its economy is proving quite resilient. I have no doubt that just as in Canada, this rising second wave will dent growth as you go into the first quarter. There is also the possibility of more fiscal stimulus in the United States that is kind of on again, off again every day. That would, if it comes through, that would further boost U.S. growth, and that would be another positive for our exports.
When it comes to the economic growth in Canada, the bank has spoken out before about household debt in Canada. It's among the highest in G7 countries. So there's a question there on Slido about what risk does this represent to Canadian economic growth?
Well, thank you for raising that. I mean, we have highlighted the risk of high household indebtedness and high housing prices, stretched housing prices. In Vancouver, you're particularly familiar with this. That risk has been there for some time. A number of measures were taken by governments, both provincial and federal, to better manage this risk. I'd highlight in particular OSFI's mortgage stress test, which I think has been effective, but that is one of a number of measures. As we've come into this crisis and the economy plunged into recession, we've obviously lowered interest rates very low. Our policy rate at the effective lower bound, quantitative easing, lowering the rates that households and companies borrow at. So if you're a household with a mortgage, you're now renewing that mortgage at a lower interest rate. That's making it more affordable and giving you more money to spend on something else or pay it down faster. The other thing low interest rates are doing, together with considerable fiscal support, is that's supporting the recovery. And the best predictor of whether somebody's going to repay their mortgage is whether they have a job. It's critically important that we get Canadians back to work. That's going to make the debt that the household sector has more sustainable. The other thing I would mention is that one of the unusual features of this recession is that household saving has actually gone up a lot. And in our own projection, we expect, and what we're seeing actually, is that households are using that increase in savings to pay down debts. They're using it to invest. Some of it will likely get spent, and that's good. That'll support the recovery, but some of it will likely be used to pay down debt. So hopefully that risk is minimized. It's certainly something that we're watching. Housing markets have come back very strongly. Interestingly, the strength has been a little less focused than usual in Toronto and Vancouver, and it's been a little bit more spread across the country, which is a good thing. We're not seeing the kind of frothy housing markets that we saw in 2016, but it is certainly a risk that we will be watching closely.
We are still seeing increases in Vancouver. You're quite right. I know that we've got time for a couple more questions. I do want to ask you about a story that I read recently talking about Canadian households, and not debt, but Canadian households are sitting on a record amount of cash right now. So what do you think it's going to take for Canadians to be drawing down on that?
Well, I was just referring to that. For a number of reasons, Canadians' savings has actually gone up quite a bit in this recession. This is unusual. It's not unusual for savings to go up a bit when people are feeling very uncertain, but the extent is unusual, and it really reflects a couple of things. Government support programs have been very effective in replacing lost incomes for those that have been hard hit by the crisis. And for better off Canadians, a lot of the things that they buy, like travel, like restaurant meals, they can't do, so they're spending less and their savings are going up. So Canadians do have an unusual stock of savings, about 150 billion of new savings at the moment. And so the question is, how does that get deployed going forward? In our own projections, as I mentioned, we're assuming that a good part of it is used to pay down debt. Some of it is invested, and some of it is spent, is consumed. I would say in our own projection, one of the upside risks is that more of it gets spent, and that would support a faster recovery. Certainly, I think getting back to the vaccines, as vaccines become widely available, and people feel like they can go back to their normal activity, that's probably the point at which you'll start to see that spending take hold. And that is certainly something that we'll be watching closely when we get there.
We have time for one more question, Governor. And, this has been a very tough year for all Canadians. So I'd like to end on a note of positivity, if you will. When you look at 2021, what gives you hope and what gives you optimism for the year ahead?
Well, thank you for that question. And I'm going to start with just a word on this year first, as difficult as it's been. As difficult as this year has been, I have to say I have been very impressed with the resilience of the Canadian economy and the resilience of Canadians. We did see an unprecedented plunge in economic activity in the second quarter, but it was actually less than a lot of worse outcomes. It has bounced back. Economy has bounced back very strongly in the third quarter, and the momentum going into the fourth quarter is even a little stronger than we'd expected. This has a lot to do with the extraordinary fiscal support, the exceptional monetary support that's been provided, but it also has a lot to do with the resilience of Canadians and the ingenuity of Canadian businesses. And so that spirit of resilience and determination is going, the immediate first part of 2020 is going to be difficult. Infections are rising. I'm not an epidemiologist, but you get the feeling it's going to get worse before it gets better. We are going to have to tap into that resilience, some Canadian prudence, particularly over the holidays, and restrain ourselves from some of the things we'd like to do. Because as we get through this, we certainly can look forward to better days ahead. As I've highlighted, I think the vaccines, the arrival of vaccines, and now the sort of emerging plans to roll those out. There's there's still some ways to go, but certainly we are all looking forward to getting back to more normal activities, and that will be an important element in securing a full recovery.
Fully agree on that, and all of us are looking forward to a brighter 2021 and also an opportunity to host you in person in Vancouver, hopefully in the next year. So Governor Macklem, thank you so much for your time. I really do appreciate it.
Well, thank you for having me, and let me take the opportunity to wish everyone the very best for the holidays, and let's hope for a much better 2021. Thank you.
Happy holidays.